Hi everyone, and welcome in this new video where it will be a talk about risk management. Risk management is something that a lot of you are trying to figure out in different ways. So we thought that it would be a great subject to have with 3 different traders and the way they are doing. You will see we are very different in the way we are risk managing, and I thought it could be a nice video to have and a nice subject to have. So for me, risk management is pretty simple. I put my risk management with 2, sometimes 3 factors, but mainly 2 factors. The first factor is my strategy, my setup, how much I documented it, how much I backtested it, and how much I made an historical journal and how much trade I have. And this data all together create me some confidence. For me, the cure to everything is knowledge. Sometimes we need at some point to stop the knowledge to think that we are going too far into thoughts. But for trading and mechanical approach plus data, we want to have knowledge. How do I know knowledge? By documenting a strategy that feels good, where I know I have a good probability to win more than losing. You just need to win a little bit more. I have an article that I just posted yesterday on Substack, for example, to this date. So it's 16th of October, 2024. And you can read it. It's about the idea of winning just a bit more than you lose, and instead of trying to get more all the time on our strategy. There is this aspect here. So when I shared my strategy about pullbacks, now I'm sharing the grids that I'm doing. The difference between me and between you guys is that if you jump into the strategy, when I propose it to you, you are just acting out of influence. So then if you take a considerable risk according to that, just because you had some trust on someone sharing you something that works for him or her, you are making a mistake. It is gambling. For me, risk is about that, and then about confidence. How much confidence do I feel today? Because me as a trader, I feel that I am the machine towards the good service of my money. So my money that I use for trading is something that serves me to make more money. That's how I'm seeing money here. We have a lot of rules that is given to us towards trading, such as you need to risk 1% of your account, then you have to de-risk, and then or some people, you need to add to your winners. You need to do add to your losers. We hear this too. All these things are individual and are irrelevant for you. For example, right now, I'm managing 2 accounts. I have my main portfolio where my risk is rather fixed because I'm growing it over time. And I have another account where I risk up to 50% of the account. Does it matter? It doesn't matter. What matters is my system that works. If it works more than I lose, I can use this edge to risk more and therefore try to make more money. So for example, if I use a small account of 10K, I can afford myself, if I know my strategy wins more than I lose, and if it does most of the time, as I'm looking for 1-to-1 risk reward, and that time I have a very high win rate, I'm able to take the risk that today I will risk say 50% of my account and potentially gain another 50%. So this is something that doesn't really matter for you as a trader as long as you're conscious about what you're doing. That's why now it's been almost 2 years soon, but I'm sharing my journal and I'm doing live trading. At least now I do only the calls on Discord by text. This has been a question that a lot of time I got, is that sometime I was getting a trade that was worth 1%. Sometime it was 2%. And sometime I've risked more. Like just as yesterday, I risked 4% of my portfolio. And the question all the time is like, why? How can you do this and stuff like that? But the thing is that I'm not seeing really my portfolio as percentage, but I'm looking more at the dollars. So meaning that you will have, let's say, a 500K account. if your risk tolerance is about 1K and you look to do 1K a day or 1K to trade, it's completely fine. And you will be happy with this 1K instead of focusing on the percentage. The percentage is just noise towards me. What matters is how you make money. But we are tend and we are sold through different softwares like automated journal softwares, different system that we need to have a consistent growth, right, of different percentage. But technically trading doesn't have to be about that. It can only be about that if you depend of another entity, such as a prop firm entity. If you will do something like DarwinX, which is a great platform, it tries to push you to build some data as a trader for you, which you can do. Then you will need to think as a constant growth or percentage. But technically, me, as I'm self-funded, I trade my own shit. I care about my own shit, and who gives a shit? So sometimes I have spikes because I've risked more and I feel more confident. Sometimes I'm a bit more slower because life is more tough. But it doesn't matter. What matters to me is how much dollars, how much euros, how much whatever crown, Swedish crown, Danish crown, every currency you want. It doesn't matter as long as I'm making the money I want, right? So when you see 4%, for example, I will risk 4% of my total portfolio. It can be also split on my account where I risk more, because it just doesn't matter. Maybe I just want to risk, like I said, 10K account where I don't have to put all my money in one account and risk more. This is a possibility. You know what I mean? So that's how I see risk. And I judge during my confidence. So if today it's a bad day and I feel pretty tired or whatever, I will risk less. But what matters is to try for you as a trader, when you are building your self account, to see how much do I want to risk today, and try to talk in yourself with the amount of cash. So today it's like, I want to do $50. I will risk $50. If you tried the other day to try to risk $100 and it feels hard, then you need to reevaluate. When you up your risk though, it's important to not just up your risk once and then you lost, because most of the time that's what will happen, psychological, the risk will be involved and in risk, like in danger, and you will want to de-risk right away. And that's where you're doing wrong, because once you decide to take a risk, you need to unsensitize yourself with the amount you've did. So if you start from 50 and it goes great, and then 100, you lose one. Oh, no. I risk 100. I don't want to lose more. You didn't take responsibility for this risk. You're just taking a bet that, okay, maybe I will do a double now, No, try to go through the fear that you decided to go for 100. And if it's not really comfortable, once you, let's say, take the 100, because you decided to double your risk, because your setup works, your strategy works, and you feel good as a trader, try to, if you can de-risk the day after, but try to make sure that you are risking this 100 again a bit later in a short term, let's say in a week, in 3 days, because you don't want to create small traumas around the risk, because after you'll get stuck for a long time. And I'm telling you, it's how it works. I see with the community and so on, like you get stuck very quickly in those psychological blockage that allow you to actually get stuck instead of trying to grow. So think about dollars. Try to think also as parables, That's what I'm trying to do a lot. And that's how my trading has been changing. I do talk about percentage in my Discord with a journal for a reason that I want to be discreet. I don't want to say how much cash I'm doing because it's just not my culture. I'm not like that. I know some culture is completely fine with it, but for me, it's something of privacy. So that's why I convert it to percentage. Otherwise, try to think of it like this. Like, for example, you will have a person or you will have something, an entity that proposes you to have a good opportunity. And this entity will propose you to maybe invest a part and then maybe in return you get this part. And when you try to think about like this, is that if you are putting $100 and that you potentially get another 100, you'll be able to think of it as, for example, money, like real money in your head, might be easier for you to put it on a trading, because sometimes all the brokerage, the candles, the way the P&L is moving is triggering you psychologically. So you try to need to make any image in your mind that could help you to visualize this in a different way. So I think that's pretty it for me on risk management. It's pretty simple, you know. So to just sum up, have a strong setup that you've worked hard at first, then that you can exploit. Don't care about how it looks. Instead, care of how it can potentially return you. This is very important. And then judge according to your confidence. So I have an article that I made, the first article I've made on Substack also that you can check. It's Pablo Pucel on Substack. Yeah, I don't use Twitter and that shit anymore because it's really annoying me, all this clickbait stuff. So Substack is a good way of having posts. I think the first article I did was the art of risk management. And you can see that I note my trades before taking it out of my confidence. That's how I'm able to fluctuate my risk. Also, one last point I want to say is that when I told you about getting insensitive about risk, what I'm doing is, for example, if I have a fixed risk and a percentage goal that I have per month, for me, a good month is 2.5%. If I reach this 2.5% and I do above with an initial risk, that's where I allow myself to risk more. So for example, this year, I'm above the yearly goal I am into. So therefore, I'm able to risk more. So the 4% I'm doing, the first time I did, got very stressed. And I said it on the journal. It was making me even sweat on the hands and stuff. It's like, it felt a bit too much. But yesterday, I put myself again into this to get better. Exposure therapy. Okay. And that I allow myself to do that because I'm above my goal of the year. So try to go step by step, you know. It's about the small wins, not about the big wins. It's not about greed. It's not about envy. This will kill you. But if you go step by step and try to build things by small step, a small step will become a medium step. And the medium step will become a big step. And then quicker than you realize, you'll be just very high on your goals. Anyway, I wish you a good day, and I will let you with Michael and Dave with their vision of risk management.
Hey guys, hope you're well. I'm just going to do a short video today just to talk a little bit about risk management and my approach. My approach is actually very simple, so this won't be a long video. Look, a lot of people have different sort of rules that they use, and they have certain at times that they might break even, or they have a very sort of structured approach to their risk management. Mine is actually very simple. My biggest thing that I use, or biggest tool that I use for risk management really, is actually patience. I actually wait to see if there's a good setup and like an A+ setup. That's my biggest approach to risk management. I don't just jump into trades. I really am trying to be more and more selective on the type of trades that I'm taking. By the way, I didn't take this trade. This is just to give you an example of what I would do if I was in a trade. So as you know, my strategy, I trade on the 5 minute, I trade pullbacks. I basically look at support and resistance on the 1 hour. And if I see rejection on the 5 minute, which also is in line with a support or resistance level on the 1 hour, I'll wait till I see the close of a candle that's in my direction. So for instance, this is the daily low of yesterday. So it's a significant resistance level on this chart moving forward. So this is the beginning of today. So that was the end of yesterday. So as you can see, we went down, we pulled back up. Once I see on the 5 minute that this is rejecting this significant level, then I'll look for a short. And I guess one way I could enter that short is straight away. I could have entered straight away on this one if I wanted to. So as you can see, this bearish candle here engulfed this, and therefore I could enter in the close of that candle. Once I select a setup that I like, as you can see, we've got this amazing resistance. So for me, this is an A+ setup. Once I'm in the trade, then I will also manage that trade now. Before I used to set and forget, but now that I'm using my own funds, I tend to want to break even at some point, and it's not right away. Obviously, I want to give the trade an opportunity to at least go my way. If you break even too soon, like for instance, if I broke even at this point, it's a little too soon. We haven't really even gone 1-to-1. Chances of being stopped for break even is quite high. And so I find if you choke your trades too much, then really you're just going to end up being a break-even trader. So you've got to be very selective and sort of disciplined as to when you do break even. What I tend to look for is I want my trade to at least go 1-to-1 before I even consider breaking even. So 1-to-1 is probably around here. It is around here. It did go there, but I still wouldn't break even here. And I'll tell you why. Because at this point, we've just hit this support, and it's most definitely going to end up wicking me if I put my stop loss here. To me, it's like, if you're going to move to break even at this point, and we've only just got started, we're not quite 1-to-1, we're still before 1-to-1. It's fairly close to 1-to-1, but not quite there, right? For me, I wouldn't break even here. I am intuitive in the way I do it, so there's not a specific rule. But for me, I just feel like I'm not really giving the trade an opportunity to work at this point. So when I most of the time wait till it's about maybe 2/3 of the way deep into the trade. So where I definitely would have broken even is here. So as you can see, this is not too far away from TP. It's probably about 3/4 of the way to TP. It broke this support area. So for me, if this is going to turn around on me at this point, I definitely want to break even. That's when I break even. And if I had broken even at that point, it still would have worked anyway. So it would have been fine. But yeah, the rule of thumb is when I start to manage my trade, I like to see it go a little bit further than 1-to-1, maybe 2/3 of the way, maybe 3/4 of the way. Or if it's really hit a significant support or resistance in the opposite direction. So for instance, if it's really hit a support level that's on the 1 hour that I think is, something I need to worry about, then I probably will break even sooner than later. But at this point, as you can see, yes, there was an hour support around here, I think, because if you look on the 1 hour, let's have a quick look. So we were up here. I guess if I was to draw it, it would have been a support level here. So as you can see, that's the blue line, which is around there. So you could argue that is a support level that you would need to kind of be wary of. But if I was worried about that, then I probably wouldn't have entered the trade at all, because I gave weight to the daily, which is this daily low. So for me, if I'm going to worry about every support and resistance that could potentially go against me, then really, when are you going to enter, right? At some point, you need to believe that, you have a higher probability of breaking through, in this instance, the support that is potentially holding you back from hitting TP. I always give weight to the higher time frame in this situation. If I really was too worried about this support area, then I would have just left the trade and not worried about it. So look, that's pretty much that is how I trade. That's how I manage my trade. I don't change my risk per trade. I don't have an A+ and a B+ and a C+ sort of setup where I de-risk on certain trades. I always risk the same, and I look for the same high probability setup that I feel is something that I want to enter. If I'm unsure, I just leave it. And that is the biggest tool that I use when it comes to risk management in my trading day. And there was quite a few days where I don't take a trade. I guess that I didn't take a trade at all. But for me, I found that the biggest mistakes that I made in trading was when I was just trying to force a setup to happen, because I sat at the chart, I gave myself a couple of hours and didn't look great, but I'm like trying to find something and trying to convince myself that something looks better than what it is. I stopped doing that. And rather than do that same mistake, I'm actually just looking for something that feels and looks good, that in a way there's no excuse not to enter, if you know what I mean. Like it looks that good. It's an A+. That's how I approach it trading now. I hope that helped. If you have any questions, feel free to DM me on Discord as part of the True Traders experience. You're more than welcome to reach out to me. And I hope that you enjoyed that video. It is a little different. I am a little bit more intuitive than most. I don't have a lot of rules, but that's just kind of what works with me. So anyway, hope that helped. Talk to you soon.
Hi everybody. Today I will talk about risk management and how I approach it and my thoughts about it and why it's so difficult and why it's so important. According to the statistics that we get from the brokers, something between 75 and 90% of all traders is not consistently profitable and are losing money. And that is kind of odd, because trading itself, making the analysis on the chart, is not that difficult. Most people can learn it. Most people can learn to draw support and resistance, use Fibonacci or whatever strategy they use, and chart them correctly, and probably also be profitable on a demo account. But again, a huge part is failing. I was failing the first couple of years, and I have learned a lot of technical analysis, nearly everything there is to learn out there. And I could teach technical analysis in a classroom and do it very well. And I could also do that when I wasn't profitable. So what is it that does that it's so difficult to have our risk management in order? Risk management is something that everyone has. Everyone in their business, in their trade. Even the best traders wouldn't survive without a proper risk management. You can take, let's take racing. You have Alonso, you have Verstappen. Their breaks is their risk management, for example. And even that they are probably some of the best drivers in the world, they wouldn't be successful if they didn't have a proper risk management in the way that they're doing their job. For example, I'm originally a bricklayer, and I could have bad days, of course, but even that, if I had a bad day, the house wouldn't crash down. I maybe do some of the work wrong, I had to redo it, but it wouldn't be a catastrophic, a big disaster. So why is it that so many people blow up accounts? Because when you blow up your personal account, that I would compare to, as my old trade as a bricklayer, if I was building a house and it would crash down to the ground. That is the same as blowing up account. I never did that. It's very, very seldom people do that when they're working to build a house. So why is it that the majority of all traders have tried to blow up their account? I blew up account when I started. I blew up account after a year. So what is it that make it so difficult, since that charting is not that difficult? I would bet that if I had most persons in a month where they sit down with me 8 hours a day, I could teach them analyzing and how to chart in a month. So they did it as much as I do, and they did it right. But I couldn't teach them to be profitable. I can give them the tools to be profitable. That is what I do besides trading in the mentorship. But having the right risk management is a personal thing that you simply need to learn, and most people need to learn it the hard way, sadly, because the essence in the risk management is also not difficult. You risk 1% and you have a 2 R trade. That is the easy part. But the emotions behind risk management is where most people are failing, and that takes a long time to learn. I think the reason why it takes a long time for people to learn the proper risk management is because trading is not an official education. Like, for example, a carpenter, a secretary, a doctor, a software engineer, a software developer, HR management, marketing guys or women who works with that. That is something you go to school and learn, and you spend years on learning it. Even today, my original trade is a bricklayer. I did that before I started trading. I know it's in Denmark where everything has to be very bureaucracy and takes a long time, but I spent nearly 4 years before I could call myself a bricklayer in school and out practicing with companies. And if, for example, trading would have the same, where you started from nearly day one, going to a classroom or go to a proper trading education, not just a course where they let you go through videos and so stuff, but where you can ask a real person questions and so on, and they can teach you. Then I think that it would be a much shorter road to be consistent profitable. At least I know that if when I began, I could have someone who has done it before and who has succeeded teach it to me. That would be different. But the trading industry is lacking of them, and that is my point of view for why so many people continue to fail, or at least take a long time before they become consistently profitable. So my own risk management, I mainly trade prop firms. I do a bit of investments on the side in crypto, but that is only a small part. And as I do prop firms, my risk management is a bit different from if I was trading my own funds. I don't want to mention prop firm names, good or bad, and so on. There's a tons of video out on YouTube. You can watch that if you want to do that. But I trade prop firms with futures and with Forex. On futures, I do it on day trading on the 5-15 minutes time frame. On Forex, I do it on the 4-hour daily time frame as a longer term trade. But both are with prop firms. My risk management is divided over more accounts, and I use the drawdown to determine my risk management. So let's say that if I have on the paper 50k account with a prop firm, it's not 50k, it's the drawdown that is your real capital. Then the drawdown is 2,500, which is 5%. Then my capital is $2,500. And I have a rule for each account. I need to be able to lose 10 trades in a row. So with that one account, my risk would be maximum $250. But since I use more accounts and I don't copy trade, so let's say that I'm using 5 accounts, then my risk is down to $50 per account out of a total risk of 500. So you can see that my risk management is a bit divided among the accounts, because sometimes I only have fewer accounts, because every time I have profit, I withdraw them. Every time I can withdraw all the profit, I do that. And on futures, then they close your account. I don't like to have money, unrealized profit on my account, because you never know when the company either goes down or you make some fat finger mistake and you lose your unrealized profit. On Forex, it is a bit different because the terms and rules are a bit different on prop firms there. But in general, I withdraw every time I can. And I also have the rules that I need to be able to lose minimum 10 trades. So for example, if I go into a drawdown, let's go back to the futures prop firms account. So if my drawdown, let's say, goes down $1,000, then my drawdown in dollars is $1,500. So my risk for that account is only $150, because I need to have the proper risk management, which is 10 losing trades in a row. That is when I go into a drawdown. If I go into a plus, I don't add to my risk the same way. I just keep the risk at max 250. Again, because my account will never go from 50 to 60,000, because before that I have withdrawn every time it's possible. So my rule is per account to be able to lose minimum 9-10 trades in a row. So let's go to the charts, and I'll show you how I technically place my stop losses and take profit. I trade a lot with RSI divergence and support and resistance. So here, the trade this here is from 24th September, 3 weeks ago or something. So here, I would have an alert up here at my resistance, and I would have alert down here at my support. I would also have alert at the top of my RSI and the bottom of my RSI. So now we come up here, my alert goes off, and then if I am at the computer and I have the proper time, I would look, there's a reaction, and here we have the bearish divergence, and because it hit my resistance, made a very good bearish reaction on this candle, I would short here at the candle open close. And my stop loss would be some ticks above this wick here. And I will look at the wider perspective in the market. And I can see that here, price is going up. And this here is the first big support here. At first hand, I will put my take profit, my last take profit down here. But as you can see, this here looks like a very juicy trade, 13, 14 RNR. And I'm sure you have seen this on YouTube many times before. But that is not the reality, because I take profit on the way. And where I take profit depends on the market structure and the price action. So for example here, this here has actually a bad market structure for me to take profit, because my first take profit would be here. And already here, I would take 50% off of my trade. So you can see from the 14 RNR, I'm down to, if the trade goes in my direction completely, I'm down to 7 RNR. So now it looks a bit more normal. And my next take profit would probably be here. It would be here. That would be my next take profit, because this here is my next support after price action. Here again, I would take 50% off. So now I only have 25% left of the trade. Let's say I went in with $100 for the sake of calculating. After this one, I have $50 left. After this one, I have $25 left, 50% off every time. 50% off the remaining capital. So now we are down here where we maybe have here. You can see now it's only 4 RNR, but I have been taking off profit. And I will follow the price action. Down, it goes down, reject from my support, rejecting, goes back up. But what I notice down here where I start to think, okay, maybe now it's time to close the trade. Here we have a very clear bullish divergence. Very clear bullish divergence. That doesn't do that I close my trade immediately, but I start to think about it. So price goes up, doesn't make higher highs as it doesn't reclaim this high here, goes down, retest. Okay, now I start to think it's time to close my trade. And here, now we make a higher high here. And you can see here it also reacted of this, my old support, which is now resistance, made some bearish reactions. So I'll probably leave the trade open, go a bit down, but when it starts to go up, I'll close it again. Of course, I can't say in hindsight exactly where I'll close it, but it would be around here something. So you can see now my trade is around, without taking profit, it would be 5.5 RNR, but because it took so much profit, it's probably not more than 2 RNR. And that is my way of having risk management on my charts. At least this is on my futures chart. On my Forex swing trading chart, I kind of use the same principle. I take profit after price action, and I close my position after price action. Yeah, and also one last thing to remember. When I take my profit here the first time, I move my stop loss to break even. So, how you manage your risk is a bit individual. But what is not, or what should not be individual, is that you have a set percentages of risk that you do not go above. So my set percentages of a risk per trade is the per account, the 10 losing traders to be able to, so 10% as maximum. Let's say that I wasn't, let's say I was a little bit in doubt of that trade, but I still have a good trade. I might go in with half the risk. The 10% per account is my max risk, and divided over more than one account or several accounts, the risk of course goes down in percentages of my total capital. And I also have what I call a daily risk and profit, not target, but where I would stop trading for the day. So, for example, on my day trading, my futures account, I have a dollar amount, not number of trades, because some people do have numbers of trades, but that I think it's better for me to have a dollar amount. So when I am that dollar amount in minus for the day, I completely stop trading and wait for the next day. It's not a target. It doesn't mean that, let's say our imaginary number is $500. It does mean that if I reach $400 minus, that I continue until I get reach the $500 minus. I trade what the charts give me. I trade the setup that it gives me. It's not a target. It's just a maximum. Again, with profit, I also have a profit maximum. Again, not a target. If my profit reaches a certain dollar amount, again and again, I look at dollar amounts because I pay my bills for trading. The dollar amount for me is more important than percentage. If I reach a certain dollar amount, I also stop trading. But it doesn't mean that if I am halfway to that dollar amount, I continue until I reach it. Because if I do that, then I'm forcing trades, and the risk is higher that I will lose all the profit on the floor. So again, risk management is both personal but should have some core principles. And the core principles is, what are you willing to lose? What are you willing to risk per trade? And what makes you uncomfortable? Because if it makes you uncomfortable, you are risking too much. You have heard that hundreds of times before, but it is very true. If you're looking at a trade, let's say that if the trade starts to go against me and it came up here, or I can use it like on this actual example. After I entered here, the price started to go against me. If when it started to go against me, I was saying, oh no, please, don't go up there, don't go up there. Then I know for sure that my risk is too high. And it can also be that for you, that even my risk profile is too high for you. So if you're using my risk profile and you are getting anxious and you are getting irritated or nervous when you go into minus, then lower your risk. Because if you're not mentally in the right place when you're trading, if something is pushing to your brain or your feelings, then you're doing something wrong, and it is often because you're risking too much. So again, it's both personal, but it's also in principle you do your risk. I know the concept for my risk is a bit different because I use prop firms, and I will explain that more in depth in another video, how I manage prop firms instead of my own funds. But for now, thank you all for listening, and I'll see you on next video.